Yeah, let's start with Billabong today. What are you hearing? What's the latest?
Carson, it looks like more lenders selling out of their debt for Billabong, and there's been an exodus. We've seen CBA, Westpac and HSB all selling now, and the latest is National Australia Bank selling its portion of debt to Bank of America Merrill Lynch, to the distressed debt unit. That means out of the big four banks, only ANZ is now left in the lending syndicate. Also, if we have a look at the lending syndicate, if we have a look at the original participants, there's also Societe Generale as well as Bank of America. So it does look like the lenders really fleeing Billabong. This is as Billabong looks to asset sales. It is trying to sell its Canadian retail chain West 49, and of course it's also talking to hedge funds and potential refinancing deals. So horrible ride for the company over the last year. In fact, just in the year to date, we've seen the shares falling 80%. So it looks like Billabong, another lender, selling out of its debt. Only ANZ, the only one of the big four left in that lending syndicate. Move for the company, so it is coming off a very low base. Of course, the flip side is it's not going to take much to move Billabong shares, but really it's a binary outcome at the moment. It's either that they do get their balance sheet in shape or they don't, and if they do get their balance sheet in shape, then we could see a sharp reversal of its fortunes, and it could be good news for the stock. Of course, if we have a look at the liabilities that Billabong has, one of the big liabilities it has on its books are all the leases for the shops all around the globe, and that's about $400 million worth. And then it also has a $400 million debt facility, which is due in July 2014. So watching how it's going to be able to meet those payments at a time when its business is coming under pressure. But the shares have fallen so steeply at the moment, it's really one or the other. If we do see a fixing up of its balance sheet, we could see a sharp reversal in its share price.
The block's up about 2.1% there after updating the market on FY13.
Looks like another profit upgrade for Flight Centre. So this is a company that has its physical presence in stores as well as the online presence, and mixes it really quite well. It is quite a big company, so it does have economies of scale, and that really gives it a competitive advantage in this space. Now, back in May, we heard of a profit upgrade, and the company at the time upgrading to $325 to $340 million in terms of underlying profit. Today, we've seen another upgrade. The company expecting underlying profit to be between $338 to $342 million. Of course, the real test, I guess, comes in the current financial year. We have seen the Aussie dollar dropping off substantially. So whether Australians are going to continue on their international travel plans as they have in the last financial year is yet to be seen, and that no doubt has been a huge kicker for Flight Centre. But watching Flight Centre shares, it should be a good day today. Another profit upgrade following the one that we saw just in May.
Novagen, ticker code NRT, and a trading halt in relation to a proposed material capital raising. They did one back in April to raise about $2.5 million. I'm just wondering broadly, without requiring you to necessarily be specific on this, what this sector is grappling with at the moment, that's such that it has to keep going back to market. I mean, it's not a good sign, but having a look at this company, it's no doubt a very small company, raising $2.5 million. That's small fry in terms of the ASX. But I guess a big difference between some of the larger healthcare companies on the market, which have been doing extremely well throughout the last 52 weeks, compared to maybe some of the biotechs, which are trying to bring new technology to the market, which are really struggling to find capital, and it is still quite a difficult environment. Having said that, one of the star performers in the past year has been Certex. It's come out with quarterly numbers this morning. The stock is up 94% in the past year. Now, this is a medical company that is growing quickly, and what it does is selective internal radiation therapy, particularly in the area of liver cancer. So this has been an area that's been growing very strongly. They've come out with quarterly growth numbers this morning, up by 13% for the quarter. So watching this one very carefully. Of course, the growth numbers aren't as good as we saw a couple of quarters ago, where we were seeing growth at around about 25% in the December quarter last year. However, still some strong rates coming through from both the Asia Pacific region as well as Americas. Today in that sector's performance?
Watching retail sales, but of course this is a historical figure, but the expectation is for growth of 0.3%. If we have a look at retail sales, there's quite a high correlation between retail sales and confidence. And really what we are seeing is probably the bottoming of confidence going into this election. So probably in the months ahead, it will be brighter days for the retail space. This number, I believe, is coming out, I think, for May. So just watching that historical figure, but the market expectation is 0.3%. That will be out at 11:30 a.m.
All right, Julia Lee.